Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the expatriation process. What is a covered expatriate? Are you a covered expatriate? And will you owe any exit tax? Expatriation can be a very complicated ordeal. That is because it involves two aspects of law. It involves the immigration component, which is physically giving up your U.S. citizenship, mailing in your I-407, or otherwise giving up your permanent residency status via the green card. And the tax implication, on the other hand, filing the tax returns, are you considered covered, and do you have an exit tax implication? So when we're talking about the formal process of expatriation, it's basically two categories of individuals. It's U.S. citizens, either born or naturalized, or lawful permanent residents who are considered long-term lawful permanent residents. That one's a bit tricky because it's if you were a permanent resident in 8 of the past 15 years, and in any of those years you did not file a Form 8833 to be treated as a foreign person. In other words, if you were a green card holder for 8 years, but in 3 of those years you properly filed the 8833 election to be treated as a foreign person, those 3 years wouldn't count. Hence, you wouldn't be considered a long-term lawful permanent resident. The other thing to remember is that it is not 8 full years necessarily. You could have like a day in the first year, 6 years, and then a day in the last year, and the IRS would say that's 8 years. You could try to dispute it, but dealing with the IRS on this issue can be mind-bending. There are some exceptions. For example, dual citizens, the certain exceptions apply, as well as that 8833 treaty election for lawful permanent residents that we just discussed. So let's start. Who is a covered expatriate? You do not want to be covered. You might see terms like covered expatriate, covered gifts. In order to be considered a covered expatriate, you have to meet one of 3 tests. Not all the tests, just one of them. Either you have the net worth test, the 2 million above test, the net income average tax liability test. Something to remember with that is it's not just your tax liability, it's net effective income tax liability. So if you're working overseas and you paid foreign taxes so that you have foreign tax credits, that may impact whether you meet the threshold or not. And then there's the 5 years tax compliance. When you are considered either a U.S. citizen or long-term lawful permanent resident, you have to submit a Form 8854, your initial expatriation statement. Some people have to continue to do it, but you definitely have to do it the first year. And it asks you on there whether you've been 5 years tax compliance. Something to remember with that. It doesn't mean it has to be a perfect filing. It just means you have to be tax compliant. So if you meet any one of those 3 tests, you are considered a covered expatriate unless an exception or exclusion or limitation applies. The $2 million net worth test hasn't changed for several years, whereas the net income average tax liability adjusts for inflation. A few things to remember with these tests, okay? 1, it doesn't have to be a perfect filing for the tax compliance. 2, the net worth is per person. So if there is a couple, if they're worth $3 million, right, you're above the $2 million, but it's actually 50% one spouse, 50% the other spouse, then and only one spouse is expatriating, let's say, or even both, but let's say one is, then that spouse's net worth is $1.5 million. They don't reach the $2 million mark. Conversely, when you're dealing with tax liability, it's the full return. So if one person is expatriating in that example, but they file a dual status return, then or a joint return, I should say, then you would include the full amount of tax liability to see if they meet the test. Another thing to keep in mind is some people, if the only test they're going to meet is the net worth test, and they think they want to gift money in order to get below the $2 million mark, the way the code's written, it would appear that the taxpayer has to be a U.S. person on the last day of the year, December 31st. There is some gray area as to whether or not it is the last day of the year, technically, or is it whether they gifted before their last day of the year. As a U.S. person, IRS would probably take the former. You would probably take the latter, especially if you gave a gift and you fall into that category. So let's assume that you are either a U.S. citizen or long-term lawful permanent resident, and you are a covered expatriate. There's just no way around it for you, okay? The next question is whether you're subject to an exit tax. So just because you are a covered expatriate does not mean you are subject to the exit tax. Likewise, just because you are subject to the exit tax doesn't mean you're going to owe anything. It's not a wealth tax, okay? There's bad information online that gives the impression that just because you're wealthy, you may have an exit tax. Let me give you two examples to kind of compare and contrast. Joe has $10 million worth of cash sitting in an account, and that is all the money he has. That is all the assets he has. He is above the 2 million mark. He's a covered expatriate, but there is no exit tax on cash. To compare that, Jane is also a U.S. citizen. She is a covered expatriate. She has stock that is worth $4 million, but she only has a $1 million basis. That $3 million minus the exclusion that we'll get to in a moment would subject her to an exit tax, even though she has less money. Okay? When it comes to exit tax, there's different categories. Not all people will be subject to the same type of exit tax. And when you're doing the exit tax, it's basically doing a phantom sale, phantom distribution. You prepare your tax return the same, dual status, but you include this income. It keeps its same character: capital gains, dividend, etc., etc. Like I said, it's not just a wealth tax. If you look online, it makes it sound like you have to pay a 50% tax just because you're exiting, and that's not the case. The common one is mark to market, and that's using the Jane example that we just had before. There's $3 million of unrealized gain between the value of the stock that the basis, and what she would sell it for the day before expatriation. That's the benchmark. You see what it would be the day before the person expatriates. Now, there's an exclusion. That exclusion adjusts for inflation as well. I believe it's around $787,000. So you have to allocate the exclusion per asset, and then you can subtract that from the gain, and the difference is taxed, unfortunately, via the exit tax. There's also something called specified tax deferred accounts, IRAs, even like a 1031 exchange. It loses that status at expatriation, and so a person may become subject to tax on something that they were able to defer previously. Another common one, is eligible deferred compensation versus ineligible deferred compensation. Both eligible and ineligible deferred compensation is used to calculate whether you meet that $2 million mark. A common question I get is, hey, I only have $1 million in cash, but $2 million of 401k. Is that going to whether I would be considered covered? The answer is yes. But how it's treated when a person exits, it's different. Eligible deferred compensation, like a 401k, for example, typically is not going to be taxed at exit, but the person will receive a 30% withholding tax at the time that they start receiving distributions. If you're covered, then you irrevocably waive the right to use a treaty in order to reduce the withholding. Like some treaties reduce the withholding to 20%, 15, 10, 5, 0. You can't do that if you're covered. Ineligible deferred compensation, like a foreign retirement plan, is a little bit different. Since it's ineligible, it's not qualified, that is grossed up into the person's final tax return. So someone may have a high pension, and that's the only thing they have, a few $1 million, let's say. They may be taxed on that. Now, one thing to keep in mind is that there is a step-up basis. So normally you could take the value of what it was when you first came to the U.S., assuming it was gained and it accrued before you were a U.S. person, and then you could look at what the value was on the day before expatriation, and then that differential is what would be taxed. For taxpayers who are only going to when it comes to expatriation, there's a lot of planning that goes into it. It's a long process. But for taxpayers especially who are only going to be considered covered expatriates because they don't have 5 years tax compliance, oftentimes they can do an offshore disclosure in order to get into compliance, and that may help them avoid any sort of exit tax. So it's important that they do that before they expatriate. Depending on why they're out of compliance, there's various programs available. There's the Voluntary Disclosure Program, VDP, for people who are willful. If someone is non-willful, there's various other programs available as well. There's the streamlined procedures, the delinquency procedures, and reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.